Right now, everyone's terrified of stubbornly high inflation. And more important, the damage the Federal Reserve might have to inflict on the economy. This is the story that controls the entire market. You know it, I know it, especially after yesterday's Fed meeting, where Jay Powell hit us with another 75 basis point rate hike and made it clear that he'll win this war by any means necessary. So tonight, I want to put this dilemma in historical perspective. Everybody knows that persistently high inflation is awful for business long term. Everybody knows that when the Fed slams the brakes on the economy, the near-term earnings estimates need to come down, possibly dramatically. That's why the stock market has been so horrendous this year. But what exactly does it mean for the market at this point in the business cycle? I think the only way to understand this environment is to hop in the Wayback Machine with Mr. Peabody and see how similar situations like this one have played out. And that's why we're going off the charts with the help of Larry Williams. He's that legendary technician I talk about. He's also a market historian who's been the #1 expert in the space since I was in grade school. Larry's written over a dozen books and created a host of own proprietary technical indicators, which you can find by going to a really cool website of his called ireallytrade.com. And what really matters, though, is that he's got a tremendous track record, especially over the last few years. Remember, he made that bold bottom call in April of 2020 when everybody in the business was saying that we'd be in COVID lockdown endlessly. Larry told us the economy would start going back to normal by mid-May. He was absolutely right. Just a tremendous buying opportunity among many others that he's given us. So what does Williams think of the current inflation situation? He thinks we need to judge the current moment against the last few times we faced extreme inflationary pressures, the analogs, so to speak. It's been a very, very long time since we've had persistent mid to high single-digit inflation. It happened briefly in the early 90s. It happened briefly in the early 90s before Alan Greenspan's Federal Reserve cracked down. Before that, we had an extremely long, horrible bout of high inflation in the late 70s and early 80s, where then Fed Chair Paul Volcker had to wreck the economy in order to get things under control. And then going back even further, inflationary shock in 1973 to 1975, and that was fueled by the first big OPEC embargo. When you look at these three analogs, Williams has spotted patterns or cycles to these bouts of inflation. He thinks it's very illuminating to project that cycle onto the present moment and see what it might tell us about the future. I think this makes so much sense. So take a look at this. This is a current Fed sticky price consumer price index in black, okay, as compared to the big burst of inflation in the late 70s and early 80s, and that's in red. Williams points out that the current trajectory of sticky price inflation has hugged this historical pattern incredibly closely. Isn't that incredible? Come on. You have to admit, that's just almost a perfect correlation. When you measure the present versus the horrific inflation in the late 70s and early 80s, this pattern puts us roughly into 1980. Back then, inflation soared before peaking out, and it did peak out, although it had some more spikes over the next couple of years. The peak was indeed in 1980. So if this pattern continues to hold, well, guess what? Williams thinks that inflation is headed lower. To me, that makes sense. Speaking as someone who lived through it, central bankers had no idea how to beat inflation in the 70s. They were totally at sea. Then Paul Volcker came in, and Fed chief hit us, boom, with a series of ruthless rate hikes, much more ruthless than the Fed would have needed to be if they'd acted aggressively a few years earlier. Sound familiar? Today, unlike back then, the Fed knows exactly how to beat inflation, and Jay Powell has shown that he's willing to bring the pain. That means it should peak sooner. Next, let's look at the same sticky price CPI number from today versus the early to mid-70s in red. Again, Williams points out that the trajectory of inflation over the past few years is very similar to what we had back then. Again, I'm talking about perfect correlation. It's almost eerie, isn't it? He says the current inflation action looks very similar to where we were in 1974, and 1974 was the peak. Two peaks. After that, we got a few years where inflation moderated substantially before it again exploded in 79, which was on the last chart I showed. Once again, Williams notes that inflation only tends to persist for so long before it burns out, despite what you hear about in the media, although how we get there varies by time period. Finally, how about the last major bout of inflation we had in the U.S. back in the late 80s and the early 90s? Once again, we're comparing that period in red to the current moment in black. And sure enough, the cycle from 30 years ago, 30-odd years ago, seems surprisingly similar to what we're going through now. And look what happens. Williams thinks it looks a lot like where we were in 1990, right before inflation came back down with alacrity. Okay, let me give you one last chart. Really kind of incredible. This takes a look at the pro shares inflation expectations ETF. Yes, the RINF, R-I-N-F, RINF, for all you home gamers. Williams points out that this was a good leading indicator for inflation on the way up. Caught it right. So it's important to recognize that this ETF has stopped going higher, definitively stopped going higher. In fact, Williams is such a believer in this thesis that he's actually shorting the inflation's expectation ETF, shorting the RINF. Here's the bottom line. The charts, as interpreted by Larry Williams, suggest that inflation could soon cool down substantially, soon, if history's any guide. Honestly, it wouldn't surprise me. We don't give the Fed enough credit for slamming the brakes on the economy, and I think we'll soon start to see the impact of Jay Powell's decisive action. That's good news for the stock market long term, even, yes, indeed, if it hurts in the short term. Let's take questions. Let's go to Eric in Pennsylvania. Eric.
Hey, Jim. Thanks for taking my call.
Of course. Thank you, Eric.
Wanted to get your long-term outlook on Enphase Energy and see how you compare it to Generac, given the recent solar litigation against Generac.
Okay, I think that what matters in Enphase is that this is probably, if you were to speak to President Biden and he were all interested in stocks, I know from previous to this he was not, this would be the stock that most correlates with his policies. So I think you can be long it and actually buy it almost every time it comes down because of the consistency of what the president really wants to have happen in our economy. Let's go to Jacob in North Carolina. Jacob.
Hey, Jim. Thanks for having me on your show. Third-time caller.
Oh, fantastic. Thank you for keep calling in. I know it's a tough market. We'll work it together. What's going on?
Oh, yes, sir. My question was about Visa stock. I mainly bought it for a trade, to be honest, because it was trading sort of the bottom of a channel it's been in for the better part of a year. But my question was, if we're going into a global recession, do you think the increased fees they have will offset the decline in volume?
No, I do not. And that's why I think that the price earnings multiple at 29 is way too high, and I don't think you should own this stock right here. By the way, MasterCard just broke 300. That was rather shocking. MasterCard has got even faster growth, and that one has no defense. Let's go to Armando in California. Armando.
Booyah, Mr. Cramer, longtime viewer since Kudlow and Cramer.
Wow. Dating me. What's up? Thank heaven for makeup.
Thank you. Yeah, my subject is CrowdStrike. I own Crowd since early 2020, and I sold some with a decent profit. My question to you is, should I buy, add more to my position, or should I hold given the economy we're in?
Well,
and the rates going.
The multiple here is 120 times earnings. That's very expensive. Palo Alto is much cheaper, and they're both great companies. So that's my compare head-to-head. All right, look, if history's any guide, the chart suggests inflation could start cooling soon. No one thinks that because of Powell's action. It might hurt stocks short-term, like we saw today, but good for the market long-term, and it could be happening quicker than we think. Much more Mad Money ahead, including my exclusive with a company called Splunk. Could this beaten-down data player be worth a second look? I've got the CEO. Then I'm cluing you in my takeaways from my time spent out west. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.